What is your process for finding either, say, super tiny Australian companies or companies in Japan?
Sure. So look, I mean, there's three key ways I generate ideas. The first, and by far the most important, is what I call cumulative, right? So new ideas grow out of old ideas. New ideas grow out of past learnings, past things I've looked at. So that could either be, a different company in the same sector. So I looked at Japan Airlines, and then I started looking at ANA, another airline, right? Or it could be, a different geography but the same sector. So I looked at JFE Steel or Nippon Steel, two big Japanese steel companies. Then I started looking at ArcelorMittal, Europe's largest steel company, or actually the largest steel company in the world. Or I started looking at US Steel or AK Steel, right? So, if it's a global commodity business, as steel obviously is, looking at a Japanese or European or US steel company, they're all much of a muchness. Similarly, if I've looked at an airline, then when I start looking at, aircraft leasing, it's an adjacent sector, so I already have some kind of bedrock of knowledge I can build upon. So at any given time, I'd say ideas in my book are probably 70 or 80% cumulative based. It's based on past learnings and areas where I've had success or failure, but at least past learnings. Then the second bucket of ideas or ways to generate is through what I call idiosyncratic. So this is essentially everything that doesn't fit into a neat, systematic kind of idea generation schematic, right? So, I'm a member of Value Investors Club. I've met a lot of really smart people on that site. Obviously, I met you through Twitter. That's another great resource. I try to read newspapers, essentially, 3 or 4 daily newspapers around the world, not just, finances, but general topical newspapers as well. I try to read blogs, investment blogs. I try to read industry newsletters like shipping newsletters or mining newsletters, these kind of things. Anything that kind of is interesting and maybe peripherally related to what I'm looking at. And look, this is very much kind of turning over tons of rocks and then maybe picking up 1 out of 10, 1 out of 15 for further work, right? So kind of an inch deep but a mile wide type approach to try and cover a fair amount of ground. That's the idiosyncratic approach, everything that's not systematic. And then the third bucket is clearly systematic. So this is essentially, proprietary screening where I will screen my 3 main markets, Japan, North America, Western Europe, for A, size, in other words, removing the ones that I think are liquidity constrained. Then I'll remove the sectors that I don't think I have any business investing in. So as you probably gathered from my kind of credit-based approach, it's very much a balance sheet-driven approach, right? It's very much a tangible asset and liability-driven approach. So if the business is like luxury goods, for example, if it's Montclair or LVMH, the real value of the business is in no way reflected by the tangible numbers on the balance sheet, right? Because the intangible component of the business's value is so high. So I could never really invest one way or another in branded, highly branded goods, luxury goods, let's say. For a similar reason, I could never really invest in biotech or pharma, right? Unless you're a doctor or a specialist, you're never going to see on the balance sheet, the value of this drug is $10 billion, right? But it could be. So no pharma, no biotech, no healthcare, probably very little software, maybe some highly commodity software, but generally no software, and no luxury goods. So basically everything else, this very balance sheet driven approach works, industrials, cap goods, resources, commodities, consumer cyclicals, obviously, and then consumer discretionary, as long as it's not too heavily branded. Those sectors are kind of my happy hunting ground. So I put those through the blender, and then after all that, I screen for some very specific, I want to say cash flow based metrics, but they're more like customized cash flow based metrics, right? So one of the things I try to do is I really try to look at what sustainable free cash flow is. So a lot of people talk about free cash flow as being, the foundation of a business's value, and I subscribe to that. But the problem is, you have to really tinker with free cash flow, right? Because if you look at free cash flow in, year 5 of the investment cycle for a mine, it might look really bad, but in year 6 it might look really good.
You're basically
right?
Normalizing free cash flow.
Yeah, normalizing. Yeah, I guess normalizing is one way to put it. I guess I think maybe a slightly more sophisticated what I try to do. So, for example, instead of just normalizing for, say, growth versus maintenance capex, right, which is a pretty standard normalization,
right?
I'll also try to normalize for where I think we are in the cycle. right?
Okay.
So there'll be some price normalization. If it's a commodity business, I'll make some normalization assumptions, not just on the CapEx line, but also on like the ASP line, let's say.
Mm-hmm.
Then I do a few other things that I think are a little bit different. So one of the things I do is I consider working capital a structural cash drag or a structural cash addition. What I mean by that is, going back to my first point, if this is a business trying to grow, then it's going to consume cash. So I don't want to give them the benefit of that growth. I want to be punitive, right? So if they're trying to grow, I will subtract the capital required to grow from my calculation of sustainable free cash flow. And the reason I'll do that is I'll assume that they're in growth mode, therefore they won't be giving that cash back to shareholders anytime soon. And that's just not frankly, that's just not my cup of tea, right? That's not what I kind of look for. So I'll deduct, say, structural working capital drag, or I'll add back structural working capital addition. If it's a service business where they pay their suppliers in 90 days but collect from consumers, immediately, and or they don't have to carry inventories, I'll give them the benefit of that on the other side as well. And then the third thing I do to adjust for my definition of sustainable free cash is I consider a structural advantage the difference between cash tax and statutory tax. So this, I think, is quite important in some industries in particular, right? So if you look at, say, aircraft leasing, which is probably my favorite space on a long-term basis, right? So one of the benefits of, say, aircraft leasing that people don't really appreciate is, let's take a company like Air Lease, right? So it's, 5 billion market cap, trades at 10 times GAAP earnings, or maybe slightly less than that. It's growing pretty rapidly. They've never really lost money. They have a great management team, basically run by the guy who invented the entire sector. And they report under US GAAP, right? So they're reporting at a US GAAP stat tax rate of, around 25%, let's say. But none of the planes are actually domiciled in the US, right? All the planes are domiciled in Ireland or whatever. So what they're doing is actually GAAP EPS, not statistically, but actually overstates the amount of cash tax structurally. Because as long as the planes are domiciled outside the US and as long as the tax laws don't change, again, those are assumptions, but for our working purposes, let's leave them as is, then, you're getting the difference between stat tax rate and actual tax rate as a deferred tax liability that just builds up on the balance sheet as a liability every year over and over and over. So what do you call something that is a long-term liability? That's actually free financing, basically, right? So the actual earnings power of the underlying business is chronically understated by the GAAP P&L, and you need to adjust for that. So I'll make all those three adjustments. I'll adjust for growth versus maintenance CapEx. I'll adjust for where we are in the cycle. I'll adjust for structural working capital drag or addition. And then I'll also adjust for what I think is a sustainable stat tax versus cash tax differential to try and get some kind of sustainable free cash flow number. And then I'll screen for that and a few other metrics around there. And then the goal is obviously on the long side to pay a very low multiple of that number. So I'll never buy something over 10 times that number. Just a hard and fast rule I have. And then on the short side, obviously, if that number is sustainably negative or, a very, very high multiple of that number, plus a busted balance sheet, plus a credit catalyst, which we can talk about, then it could be a very interesting short.
And what are you using to screen?
So look, Bloomberg is a pretty useful tool, right? So EQS is the function you can do an equity screen on. Okay. So essentially, you can set that screen up pretty quickly and just run that, say, once every couple of weeks. It doesn't have to be on a daily basis, right? Things don't tend to move that much. So I use EQS as my go-to.
Got it. Cool.